Hi, and welcome to this week's Market Pulse and Strategy Review. What we'll be doing today is looking at how the markets have been moving over the last few days and what is coming up this week. What do we expect um, from the equity markets, bond markets, uh, as well as the currency markets, such and some updates about Helix and what we are doing currently. So, some of the things that we've been working on is expanding our network of advisory offerings, and we've signing up more and more clients who are interested in our OCIO services, outsourced Chief Investment Officer services. So that is suitable for a family office or a small to medium sized institution that needs sophisticated investing experience, but at the same time can't build it in house. So there are a number of clients that are reaching out for our OCIO services. That's one of the areas that we've been uh, particularly working on. Secondly, another area where we see a lot of interest is around the sustainability linked loan. So many UK and European European businesses, I would say small and medium sized businesses that are looking to transition towards a green economy and require financing for that, or they are implementing certain green technology, and for that uh, they require financing. So we are able to use our network to source the right structure for them. So we use a sustainability linked loan structure, so which means that there are sustainability related conditions for the company to meet, and thereby they're able to get a slightly lower interest rate than what they would have got in the market. So those are things that are going on. We've had a large European family office that we're talking to. We're starting off with the due diligence. They're interested in investing in our hedge fund, so that can really scale this further. There's also another firm that is also interested in the hedge fund, and thereby we are starting off due diligence with them. So while that is going on, we are continuing to have discussions with a number of individuals who are interested in the fund, and they've reached out to us directly. Uh, as always, there are questions around the suitability of such investments. And the other side is also the tax implications, with respect to a hedge fund investment. So we typically refer these to accountants on our network or independent financial advisors who are on our network, so they can guide them with respect to these questions before they make an investment with us. Um, so always happy to include other LPs, other uh, you know um, accountants or independent financial advisors as part of our network. We're always in need of these skills as we get asked a number of questions around the suitability of the fund, as well as the tax related implications for themselves, for understanding their unique circumstances as such. So what is happening in the market? So one of the things that we've been tracking is how the US is moving in the both in the macro space as well as the environmental space. If you remember, we are eco-economics, so there is economics, there is eco in front of it. So we always want to understand, you know, what are the sort of challenges that are there. The U.S. Has formally withdrawn from the Paris Agreement, but more recently, there is instruction to the EPA, the Environmental Protection Agency, to kind of dilute its stance with environmental regulations for fossil fuel projects. So that means that, if you remember, Donald Trump's inauguration, he mentioned drill baby drill. He is basically implementing um, on that promise. So he wants to drill more. So on the other hand, the clean energy transition now needs leadership, and that has fallen, squarely in China's hands. So China today is not just the manufacturer of choice, but also a leader in terms of climate financing, in terms of um, you know the impetus from a policy perspective. So a lot of that has shifted essentially to China. Uh, of course, there is a lot of work that the European Union has done in terms of environmental regulations. But on top of this is core manufacturing capability and the ability to execute at scale, which basically China brings in, right? So, in terms of where we are going currently, if you look at the current oil market demand, prices have been on the defensive. And if you will know from the last few, I think we've been saying over the last 12 quarters, the OPEC or the OPEC Plus have been having pretty much a tepid forecast of demand, right? And with that, they've done a number of supply cuts in order to keep price uh, stable, right? So uh, there's basically a kind of a benchmark at about $65 a barrel, right? Below which it becomes unprofitable to drill anymore. So uh, so what is happening with this is, if the US wants to drill more, that puts a lot more supply pressure. So on one side, there is a declining price due to the declining demand, uh, and there is excessive supply. So that presents a real risk in the market. So for any um, fossil fuel related investment, as well as overall, the US and Canadian economy are tied very closely with oil. And in spite of what we want to talk about, there is, say, a vast majority of the oil contracts are written in dollars. So, so if oil price goes down, it further strengthens the dollar, and with uh, the tariff-related pressure that has already been added. So one of the things that I've been saying all along over the last few weeks is that um, since the 20th of January, whatever this administration has done, I can't see a spark of brilliance, despite looking at it so hard and trying to understand what they're really doing. I can't see a spark of brilliance here, right? So fundamentally, the debt to GDP ratio is at all-time high, and it has been at all-time high for a significant time period in America. Uh, Please don't take Japan into consideration. Then tell me 250% debt to GDP ratio in Japan, and they've had pretty much of economic softening for quite some time. That's not the case with the US or with the UK or with the European Union, etc. So I would take Japan as an outlier, keep it aside, and look at all the other countries. Um, so if I would look at that, that is one big issue that I primarily consider, and I also consider the household saving rate, uh, which is at all-time low. So if you wanted to, um, tackle, um, the fiscal deficit, then savings rates have to go up, which is obviously not the policy that this government uh, uh, is proposing to do. Um, on the other hand, we also look at the market cap, the stock market capitalization to GDP ratio. In the US, again, we are at all-time highs. That means that the market is quite overheated. So, despite what we see on the S&P going up slightly, etc., I think the overall direction for the S&P, as well as the Dow Jones and the Nasdaq, this year is going to be downward. So it's quite bearish, um, from a market perspective. Right? That's one of the learnings that we've had over the last few months, looking at how markets have been performing. Um, if we look at how now, while Donald Trump wants to prioritize fossil fuel investments by publicly listed oil and gas companies actually fell over the last, I can say, all the way from pre-pandemic, right? It's been falling uh, by about 6.5, 7% every year. And most of the investments are actually going into clean energy technologies by these fossil fuel companies themselves. So if you look at many of the fossil fuel companies, they have technologies in place to produce hydrogen as a fuel of the future. Um, and they've also invested significantly in producing ammonia and producing also on carbon capture. Right, these three areas are where their investments are going, not into new oil fields and oil exploration, etc. So U.S. policy seems to be going in an opposite direction to where investments are kind of tracking currently, right? Looking at overall, climate policy and how the energy transition is taking place, uh, I really always thought that the net zero was pretty much of a stopgap arrangement, right? So there can't really be a net zero as such. It's got to be an absolute reduction of emissions in real terms that we should be prioritizing. Um, but if you look at how the oil market has provided us insight, there's a slow tapering of oil demand globally, uh, and over the last 10 years, oil demand has been going down and is projected to go down further. The demand for clean energy has been going on the other side, right? So uh, the renewable mix in most of the major economies is increasing year on year. So the share of renewables in the energy usage uh, is actually going up year on year. So policies have to be aligned towards that. And when you try to kind of go, I would say, um, in kind of front and back kind of a movement with trade, with energy, with fiscal policy, etc. What happens is the market doesn't like this uncertainty, right? And which is exactly what um, I'm predicting as well, right? So from my perspective, the way I look at it is a bad policy is okay as long as the policy is stable, right? And we're not changing it every few days or weeks. A good policy is good as long as it stays stable. If you keep changing it, it causes uncertainty. And I think that is where the problem lies. Too many changes, too many mixed pictures that are coming, right? Um, Next, if we look at uh, what are the sort of strategic implications here? Um, in the short term, I think oil markets remain sensitive to geopolitical shifts. Uh, this supply demand is always a balancing act. But then uh, looking at the information from OPEC and from the IEA, in the medium to long term, oil's share of the global energy mix is declining, right? And it is declining in every market. Energy transition is no longer kind of theoretical. It is real. It is happening on the ground. Um, while North America, the two particularly US, is still debating it. Uh, China is leading at the front, which is something to consider. And again, looking at the US itself, a vast majority of climate regulation and climate related incentives, sustainability related incentives are at a state level, which this administration can't really touch. Uh, More than that, what we also have to look at is how is the administration placed in both uh, houses of parliament. So in both the Senate as well as the Congress, uh, the Republicans have a small majority at the moment. They can claim to be majority, but there are elections coming up, and it could tip the balance, right? So that is something to be really aware of. Without a Republican majority in both houses, getting all of these considerations out of the way, all of these executive orders executed really is going to be a real challenge. Um, and if you see more recently, a number of the cuts that Elon Musk and his Doji group did have been termed illegal. So again, there wasn't really a big cut as it was promised. So there wasn't really a fraud and over expenditure that they really cut. So a lot of that boils down to optics, and those optics didn't really fly really well, from that perspective. So uh, some of the key changes and what is coming up this week. So one major implication that I'm going to be looking at is a sort of the various indicators that we are looking at. So first of all, there is the central bank policies coming up. Um, there's speeches by the Fed. We'll also be closely watching um, the Bank of England as well as the European Central Bank's stance on interest rates. Um, Looking at inflation, I would say somewhat moderating. But again, we only measure goods and services inflation. We don't measure asset inflation. None of the central banks measure asset inflation, and I think that is where a lot of the problem really sticks. Right? Um, is the global GDP slated to grow? Yes, about 3% sort of expectation. But then some of the macro uh, indicators that are coming up in the next few days to weeks, the personal consumption expenditures in the US coming up on 30th of May. There are a number of speeches by the Federal Reserve. Uh, Bank of Japan's conference coming up. There's inflation data in France that we'll be tracking. Among the earnings, I think we are interested in Nvidia and Dell, both of which are reporting earnings in the next few days. The reason why we are interested in looking at this is we want to understand the extent of expansion in AI and how that is playing in the market. Uh, I don't really give a lot of emphasis to smaller firms coming in and rocking the market. I'd be very interested in looking at firms like Nvidia and Dell, of course. Nvidia more specifically from the AI-related processor market. And if they are selling more, it shows that there is more demand for AI and its AI infrastructure. While the S&P is not at its all-time low, uh, it's uh, likely to touch a 600 mark within the next 2 to 3 months. But then I think the point that I was trying to make all along is that could be small bull runs, but the overall kind of outlook uh, that we are getting from the S&P is bad. It's had significant drawdowns this year. If you remember, early April there was Liberation Day and a 17% drawdown on the S&P. Our fund has been quite resilient in this perspective. What we did was to close our positions up, anticipating this, and we had a drawdown of about 4.1% on that particular day, but then we recovered the next day. Uh, so trade policies always been quite stable all along. Now there is unnecessary disputes um and tariff implications which are coming up. Again, am I worried? I think I'm worried about the uncertainty that it these uncertainties can give us a number of hedge fund options for us. Right? From Helix's perspective, it gives opportunities in both the sides. I can definitely take long as well as short positions, and we can definitely make money. But does this help you as an investor? Right? Unless you are tracking the market every single day and moving your money left, right, and center, it's going to be a problem, right? Which is exactly what I was indicating right at the start of this year as well. Uh, there are a number of earnings releases that we are tracking other than NVIDIA and Dell that I mentioned. We're also looking at Salesforce. So this gives us a bit more indication into how enterprise software is kind of working currently, whether it kind of gives us a little bit more of a positive outlook for enterprise software. We're looking at Costco, a major retailer, and Costco's performance can indicate consumer spending pattern, right? And I'm also looking at the personal consumption expenditure in the US. So obviously, looking at how Costco's earnings is playing up. Dollar General, we also track Dollar Tree, um, but Dollar General's earnings coming up on Thursday. Um, so we want to understand how low-income families and low-income consumers are behaving in this current sort of economic condition, and that's one of the reasons why we're tracking these companies. Uh, so those are few of the firms that we're looking at. Um, AI and tech investment that I mentioned, something that we are deeply interested in, and we want to understand how Nvidia and Dell's earnings can kind of play into this. Consumer spending. Are they spending? Are they pulling back? Where are they spending? Uh, Also remember that there's always the sort of lipstick phenomenon. So what this means is when a recession hits, women tend to stop buying all of their cosmetics and dresses and shoes and whatever, but they still continue to buy lipstick. So there are some core elements that will continue to understand which one are the core. Understanding enterprise software demand will help us understand how enterprises are likely to invest over the next few quarters. And as always, we are tracking industrials, we are tracking food, we are tracking transportation, because we want to understand how the tariffs are playing. So these tariffs, by the time they kick in, they will show an impact on the corporate earnings, and that is what we can understand as the real impact itself, right? So those are the updates from our side. So happy to answer any questions. Please leave any questions on the chat, and I can pick it up. I can answer them during the day, anytime during the day. But we'll close our live broadcast now. Have any questions? Please feel free to shoot that on the comments. Thank you.